It's just crazy. I don't get it. But as Maynard Keynes said once, and this is one of the only things that I agree with him saying, is that markets can remain irrational for longer than you can remain solvent. Wednesday, July 7th, 2021, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at how, in my opinion, the Federal Reserve is keeping investors on a sinking ship or on the Titanic. And that's an analogy, of course, for the currency, which is losing a lot of value. Not that it hasn't been losing a lot of value since the inception of the Federal Reserve, nor since 1971 when Nixon closed the gold window. But I think it's accelerating now. It's flowing into tangible assets, into commodities. We're going to look at commodities. I don't think the Fed will be able to fight this inflation. And why is that? Well, because they're the ones who created. Inflation is not created by greedy business people or others. It's not created by rising prices. Rising prices are the consequence of inflation, of course, which is a monetary phenomenon. Before I start and look at the commodities and what I'm seeing, let's make a few announcements first. Well, the first one is that it's July 7th. And why is that an important day? Well, it's Billy's birthday. He's 13 today. We got him back in 08, right towards the end of the summer of 08, during the great financial crisis. So we kid at home that he's the credit crunch puppy. So there you go, Billy's birthday. The other thing I like to announce is a big thanks to a few of you who have sent me some very nice items through Gold Investments. I don't have a post office box, and I don't plan to get one. I've checked with the Royal Mail or the post office, and it's about $800 a year to have a post office box, so it's not worth it. But anyway, I'd like to thank Merritt, Alan, Gary, and Harry, and they know what I'm talking about. So thank you very much, guys, for that. It felt like Christmas yesterday because Gold Investments sent me everything in one package, and there was quite a bit in there. And what they do is they sent me the stuff that I get through them once a month. That's why maybe some of the people that I thanked, they might have been wondering, hasn't he got the package? But I did yesterday. So having worked in the financial markets for fund managers, for brokerages, for banks from 1989 to 2012, the way the market is looking now, looking at all different assets and indicators, doesn't make me feel very comfortable about things. It makes me very confused. Back in the 90s or even early 2000s, for example, different asset classes used to react in a different way. For example, when you had very strong numbers, like economic numbers, what would happen is that the bond market would drop, the prices would drop, yields would go up, and that would rebalance things. The market used to point out to investors, look, the economy might be overheating a little bit, so yields are going to go up, stocks will come down a little bit, and then you can start again. But nowadays, with the Federal Reserve and other central banks intervening and manipulating everything, especially interest rates, things are getting crazy in my opinion. And even though I haven't worked in the markets since 2012 in the financial markets, I've been following them every day. It's something that I do, especially here on this YouTube channel. And things are just getting really, really out of hand. And the Federal Reserve is basically trying to kill the canary in the coal mine so that people don't get a signal. They're trying to keep the barometer of monetary profligacy or monetary recklessness from being shown in its real, how can I say, natural way. They're manipulating a lot of things, but I don't think it will last very long. They can't keep doing this forever. If it was possible for individuals, a few individuals in the boardroom to keep things going like that, we wouldn't need a real economy. We could just give people money and people would live happily ever after. But we know that in a sound, prosperous, free economy, people need to create value and exchange freely amongst themselves. They need to produce things that are useful. And I think that's out the window right now. So what do I mean when I say that the Fed is trying to keep people on the Titanic, trying to keep them from not jumping onto the lifeboats or jumping into the water with a life vest, so to speak? Well, when I look at all the different anecdotal stories of shortages of, for example, supermarkets stockpiling inventories as they expect food costs to rise. And this is coming from the Wall Street Journal. So it says here, grocers are setting aside larger amounts of frozen meat, sugar, and other items to protect profits ahead of anticipated price increases. So this is not a symptom that we have deflation, that prices are under control. I've never seen this before, supermarkets stockpiling inventory. I've never seen used car prices going up so much. Usually used car prices always lose value. And the other thing we have to worry about, of course, with the crisis that we've had since the beginning of last year is all the supply chain and all the disruption. And from what I hear from my viewers, all the anecdotal evidence of price rises, of shortages of labor, it just feels crazy that bond yields are dropping so much. But that could be also a signal that investors may be a little bit concerned about things in general. Yesterday, we had a big drop in the Dow intraday of over 400 points. And we saw the 10-year yield drop 8 basis points, which is big, believe me, because I used to work in the government bond market. We saw the 30-year yield get below 2%. I mean, how can investors justify parking someone's capital? Because a lot of these people that manage money, they're managing money for others, for pension funds and very wealthy individuals' money. How can they justify that when the national debt is growing? It's almost at 30 trillion. It's supposed to get to 50 trillion, not in 30 years' time, but in 4 years' time. That's what the US debt clock is telling us. How can a currency survive such growth of debt and deficit spending? Yes, we are told by politicians that deficit spending was just to fight the pandemic and everything's going to go back to normal now. Things are going to be okay. Everyone's going to go back to work, and we're going to get the deficit back down. But even before the crisis, the US and the UK, for example, were already running big deficits. The US, 5% budget deficit to GDP. The UK, I remember very well in 2010, George Osborne, the then chancellor, saying that the budget would be balanced by 2015. And even before the pandemic last year, the deficit was running at over 2%. So this is a pipe dream. So that's why I think there's something really wrong out there. And under the hood or the bonnet of the financial markets, there is something really bad going on. And I think the reverse repo is one of those things. I'm not going to go through the repo. What the repo is, I've got a playlist. You can go onto the playlist and listen to it. There was, of course, a repo crisis almost 2 years ago in September 2019, and that didn't end up well. This crisis is different, but there's definitely something wrong here. It's quite tricky to understand all this. The Federal Reserve has created such a monster that not even people like me who know a little bit about the financial markets and the plumbings of the financial markets, I find it difficult to understand. I find it difficult to understand as well to see the stock market reaching all-time highs almost every day and bond yields dropping. That's something that's crazy, that never used to happen. So all I'm trying to say here is that I think what they're trying to do is to paint a pretty picture here of everything, but things aren't that pretty. So, and I think commodities, with an economy slowing down, is a bad thing, of course, for them. It's stagflation. And I think we have that. For example, so yesterday we had some ISM non-manufacturing data. And this data is like a survey of businesses in the non-manufacturing sector. And any number above 50 means the business is expanding, or they expect the business to keep expanding. So the previous month, that number, non-manufacturing business activity, came out at 66.2. It was expected by economists to rise to 66.4, but it came at 60.4. That's a big drop. That is worrying. We saw non-manufacturing employment drop from 55.3 to 49.3. The significance of the 49.3 is that it's below 50. That means that employment, these people surveyed expect employment to shrink. The prices, non-manufacturing prices, yes, that came down slightly from 80.6 to 79.5, but it's still very high. So there you go. That's a stagflationary environment. We'll have to keep an eye on other data coming out in the next few days and weeks, though. And I wanted to show you the commodities, because as I've said before many times, prices don't go up in a straight line. And as you can see here by this chart of the CRB index, and the CRB index, of course, is an index of all the major commodities. And I have to thank Rafi Faber for catching on to this. He notes that the 50-week moving average is just crossing over the 200-week moving average, which is a golden cross. In the past, this has been an indicator of an intermediate top or the beginning of a major bull market. The last time that it was an indicator of a major bull market was in 2002, bull market in commodities, of course. And I have a feeling this is just the beginning. Yes, commodities have stabilized recently. They have come off a lot, and we're going to look at lumber and copper and why I think they've bottomed. And their bull market, or the bear market in the dollar, is far from being over, because you need to understand commodity prices going up is just the mirror image of the dollar dropping in value, because if you need more dollars to buy real things, that means the dollar is going down in value, and the whole world will suffer from this, because the dollar is still used as the reserve currency to buy these commodities. This is a weekly chart, and as you can see, the trend still looks very bullish, and we're nowhere near the high that we reached back in 2008 when Billy was born. So there you go. That's the CRB. Yes, yesterday morning, commodities are doing really well prior to the US market coming in. They didn't have a great day yesterday, but that's very short-term noise, I would say. So let's have a look at lumber here, because lumber is starting to look very interesting. And as you can see here, I tweeted out on the 17th of June, I said long-term trend for lumber still looks bullish, which means a bearish long-term trend for the dollar. A bit more downside, but around 800 looks like a good entry point. And I put that chart there. That's a weekly chart. So let's have a look at what happened since middle of June when I tweeted that out. There's the weekly chart of lumber. Yes, we dropped to that trend line, and now look at the rebound. Of course, it's still early days, but it looks like it held that trend line. And then look at the daily chart. There's that trend line again. It looks like it bounced right off that line, and now it's starting to pick up again. Copper. Let's look at a chart of copper, a weekly chart of copper. Yes, copper made an all-time high. It broke the high from 2011 earlier this year. It almost went up to $5. It came down and it touched that trend line, as you can see, and it looks like it's now rebounding from that trend line. And we've seen, of course, how the energy sector prices there are continuing to rise. Yesterday, I think crude oil actually got to $76 WTI. And yes, it did have a big drop later on in the day, but we're still around 73.58 here. It's up 1% overnight. And the other commodities that are not looking great for the consumer in terms of the fact that they're rising in prices are gasoline, as you can see here by this chart. It still looks very bullish, gasoline futures prices. And I think producers of all these commodities, they're starting to realize that there's no end in sight to the monetary and fiscal stimulus, that there's something wrong with the economy. And unless the Fed came out intra-meeting in an emergency, for example, and started raising rates aggressively towards 3-4% in less than a year, we're not going to see anything change, in my opinion, and we're going to continue to see the currency lose its value. Yes, the central bankers, the mainstream economists, they're going to try to convince you otherwise and keep you on the Titanic, keeping you on the dance floor in the ballroom if you're wealthy enough to be in first class. And if you're not, they're going to keep you, down there in the cheaper levels of the ship. But you don't have to stay on the Titanic. You can try to get out. You can try to get on the lifeboat. And as we know, there weren't enough lifeboats on the Titanic, of course, which was a big crime, in my opinion. And it's the same thing for the financial markets. There's not enough insurance or protection, at least at the prices we have. And of course, those are hard assets like commodities, like precious metals, like, real assets. So with that, let's quickly look at where the markets are this morning. It's just gone past 9 a.m. London time. We've got spot gold at 1805.50. Gold is up about $9. The high's been 1807 and the low 1794. Yeah, gold did well yesterday in the beginning of the day, and then it came off. But yeah, I'm not concerned, as I said. I even did buy a little bit of gold this month from Gold Investments. I happen to have some extra fiat currency. So for the first time in a while, I bought some gold instead of silver. And I got quite a bit of silver actually yesterday in my package. Thank you very much again. So silver is 26.35, up 20 cents, or 0.75%. The high has been 26.40, low 26.05. The Dow futures up 30, NASDAQ 100 futures up 77, S&P futures up 8. The currencies, we got sterling up slightly, 138.07. The euro up very little as well at 118.29. The dollar unchanged versus the yen at 110.68. Dollars down 0.2% versus the yuan at 646.64. Let's have a look at the Aussie dollar. Aussie dollar is at 75.12. It's up 0.2% overnight, but it's down quite a bit from yesterday morning when I spoke. I think it was almost at 76. So let's look at the dollar versus the Canadian dollar as well now, because I have a lot of viewers in Canada. So the dollar is down 0.2% versus the Canadian dollar at 124.35. So, and a quick look now at the general commodities. As I said earlier, crude oil is up. High-grade copper is up 2% this morning. It's at 433. And to finish off, with the 10-year yield, really treasury yield, which in my opinion is a false indicator. It's not a real free market. And of course, we haven't had really a free market in many decades, I would say, or ever since the Federal Reserve was created, maybe the markets haven't been as free. But be as it may, right now, the 10-year yield is down another 3.5 basis points. So we're down about 10 basis points since yesterday. I don't get it. I worked in these markets for 20 years, especially treasuries, German government bond futures. This is not normal with what's happening out there in other asset classes. So we're at 133. The 30-year yield is at 196. So that's down another 4 basis points. And even if their favorite measures of inflation, CPI or PCE, drop towards maybe 2-3%, those rates are still not protecting investors. They're still giving investors a negative real rate of return. But right now, CPI is almost running at 5%. Why would you want to put someone's money or your money in an instrument that gives you a return, a yield of 1.33 when the currency has been debased by at least 5%? As we know, according to John Williams of Shadow Stats, the real rate of CPI is more like 12%. It's just crazy. I don't get it. But as Maynard Keynes said once, and this is one of the only things that I agree with him saying, is that markets can remain irrational for longer than you can remain solvent. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.